Okay, so we haven't looked at many very, very small companies yet on this show. Today we're going to do that. Today I found a company called OPM or 1PM. Epic code is OPM. I want to look at these guys today because they're exciting and they're risky and they're tiny. They're a very small company relative to what we've looked at already. And but they're exciting at the same time, and so I'm excited to share this company with you, and I hope you'll join me for the ride. Hey there guys, welcome to the FTSE Show. My name is Chris Chillingworth. This is the show where we dissect different FTSE companies over the different episodes, looking for companies that have the best or the highest odds of being that kind of 300 to 400% growth company over the next 10 or 20 years. So we're talking long-term holds. We're looking at companies that might be able to make us an annual average return of, let's say, 15% or more. So, you know, we're looking for particular measurables in these companies. If these companies don't have it, they score poorly. If these companies tick all the boxes, they score very highly. And so today I'm going to take a look at a company called 1PM. I keep calling them OPM. That's their Epic code, OPM. But their company name is 1PM. These are a credit finance company, which is risky in 2020 for sure. I believe they provide most of their finance to small and medium sized businesses. Also, a bit of a risk in 2020 when you've got a lot of companies that are potentially facing closure, defaulting on repayments. It's difficult to know just how bad a problem that is out there right now. A lot of people I've spoken to have said they haven't been that affected by things in 2020, and actually they're doing okay. Other people are saying that, you know, they're laying off staff, so it's a really difficult time to know just the lay of the land and really getting a good view of things. Like I say, this is a risky company to do today, but potential there as well. So without any further delay, let's dive into those numbers. Okay, let's take a look at OPM or 1PM. These guys are in the FTSE AIM market, and they're in the finance and credit services sector. So, very small business, first of all, as we can see, back in 2008, turning over £805,000. As of 2019, they're up to 31.8 million. So definitely some impressive growth there, even though they're still a very, very small business. But we can see here the revenue growth has been pretty much substantial over the last 10, 11 years. Every year we seem to have moved up pretty much, and some of them have been quite big leaps from 2015. Making 5.5 million to 2016 making 12.5 million, then to 16.9, then a jump up to 30 million. So, you know, they've been doing pretty well there, and I'm pretty happy with that revenue growth. That is pretty substantial and rather solid. Looking at the gross margin, again, I'm really happy with this gross margin. Look at the consistency here. So what we're essentially saying here is, what's the slice of the pie that these guys are keeping? Well, back in 2011, we're sitting at 41%. Then it went up to 44, 46, 52, 54, 64, stayed at 64 for 2017, then up to 66, and as of 2019, 67.7%. So what this is telling us is that the revenue is growing. Cost of sales is growing, but cost of sales is growing nowhere near as fast as the revenue that's coming in. And as a result of that, the gross margin that these guys are keeping, the gross profit, comes to 67.7% of the revenue. They're keeping the 67% of the revenue, which is fantastic. Now, looking at expenses are definitely going up. So that's a down point for these guys. Back in 2014, we're looking at 38.1% of the gross profit being eaten up by expenses. In 2019, that's now 61.7%. So again, as the company has grown, we've seen the expenses of running this business climb from £844,000 a year to 13.2 million. So these guys have grown very quickly and very fast, but quite substantially at the same time. And unfortunately, those expenses have grown faster than the revenue. So that's something to be mindful of. But these numbers are still well within the thresholds of what I look for. So I'm happy with these numbers. I'm not so much happy with the trend, the increasing trend of the expenses. That's the only down mark for them so far for me. Interest on debt, not an issue, 1.8% of the gross of the operating profit, so that's very, very little. Operating profit, by the way, as of 2019 is 8.2 million. So of the 31.8 million that came in, the operating profit sits at 8.2 million. The interest on debt, or the financial interest, is £151,000, so it's nothing really in comparison. And then we'll come down to the true net earnings. This is net earnings with all of the sales of assets and anything that's not that's income or liabilities, assets or income or expenditure that isn't to do with the everyday recurring revenue of the business. It all gets omitted from these results. And so what you're looking at here is the true results from the everyday recurring business that they do. And as of 2019, we're looking at a profit of 6.5 million from a revenue of 31.8 million. That gives them a 20.7% net earnings. And that has been relatively consistent. Back in 2012, we were sitting at 15.2, went up to 19, then it went up to nearly 25%, where it stayed between 2014 and 2016, and then it's fallen to about 21% over the last 3 years. Now, 20%, very, very good. Very happy with a 20% net earnings. Any company making 20% or more is doing something very, very right, and they're being very successful. It's a great margin as well, so if you get any spike in tax or spike in expenses, or any event happens that's kind of unforeseen, you're probably still going to be posting a profitable year regardless, because of that huge margin of 20-odd%. So this is a company doing very well, and as the revenues have been growing, obviously the net earnings have been growing. We've seen the net earnings grow from 2013 603 million in profit. 603,000 in profit. That's 603,000 in profit in 2013. In 2019, 6.5 million. So that's a substantial growth over that period of time. 6.5 million in 2019. Coming down to the balance sheet, we've got a healthy current ratio of 1, which essentially means that the current liabilities are matching current assets, so that's good. That's healthy. They don't have much in terms of property, plant and equipment, and most of their non-current assets are in goodwill, which would suggest some sort of a acquisition at some point, probably 2017, 2018, looking at these numbers. But I'd have to dig a bit deeper to find out what was going on there. Long-term debt, very much nothing to really talk about. £469,000, which for a company making 6.5 million a year in profit means, they could pay that off in an instant. So no issues there with the debt that they have outstanding. It's almost not even worth talking about. And we can see shareholder equity, the net assets, the assets minus liabilities equals what's left over, climbing every single year, now sitting at 53.7 million in value, and that's been jumping up quite considerably every single year, so that's great. That shows that this is a company that's growing, its assets base is growing, the equity in the company is growing. This is all looking very, very good, and the only downside so far that I have seen would be the increase in expenses more than anything, really. That's pretty much the only thing. Looking at retained earnings, again, that's been climbing. Back in 2012, we're sitting on £76,000 in retained earnings, now sitting on 19.8 million. There you go, got my words out right there. 19.8 million in 2019, and we've seen an average growth in retained earnings of 63.8% a year. So they are pumping a fair amount of money into retained earnings every single year, quite a substantial amount for a business of this size. So that's very impressive. Return on equity is not so great. The return that they're making off the equity that they have is only 12%. That's a kind of a downtick for me. I like companies that are making big returns and smaller equity, but they're doing pretty well. And so this is a company that I have to say are looking very, very good. Very early days. These guys, again, FTSE AIM company. They're in the finance and credit services, so that's something you've got to bear in mind in 2020. But growth-wise, we've seen fantastic growth. Let's take a look at the chart. Okay, so this is fascinating to me. Genuinely fascinating. Here we have a company who, on paper, with the financials, look very, very solid. They appeared on the markets, on the exchange, back in September 2006. In terms of data, we pick them up in 2008, but back in 2006, when they first appeared on the exchange, they came in at £4 a share. By 2008, they're down to 40 pence a share. So since they appeared on the London Stock Exchange, they have just plummeted in value in terms of share price, for sure. And then from 2008 onwards, we've pretty much been stuck at pretty much the same level, stuck in a range between, let's take a look, 2 pence a share. Crikey. Yeah, down to lows of about 5 pence a share. Let's get it right. Up to highs of about 80 pence a share, currently sitting at 24 pence a share. So this is really interesting, because here we've got a company that are scoring some very impressive growth numbers on the financials, but we're not seeing it in share price. Share price really hasn't gone anywhere. And if anything, we've seen it in a bit of a downward trend from 2014 to present day. We've just seen it dropping. And that surprises me considerably. Back to pre 2020 crash price, we're looking at 34 pence. It's dropped all the way down to about 10 pence, and now it's coming all the way back up to, it's come back up to about 25 pence right now today. So for me, this is a very surprising chart considering the numbers we've just looked at. Again, I would suggest proceeding with caution with a company that are currently providing loans to the commercial and small to medium enterprise businesses. I believe they do. Obviously with the lockdown, the number of businesses that potentially gone out of business over the first kind of Q1 and Q2 of 2020, there may be some issues there with this business. I don't know. I honestly don't know the details here. But the share price has only really done anything but recover over the last 3 months, from 10 pence to 24 pence. And, when we look at Aston Martin, for example, this is a company, Aston Martin are a company that are hemorrhaging money. They're making massive losses year after year after year, and the picture does not look pretty. And when you're looking at the share price, you kind of think, well, they deserve that share price because they're right down there. The numbers are very, very poor. They're not making any profit, and they haven't been for a long time. Now we look at a company called 1PM, much, much smaller company, completely different business. But here's a business that financially, looking at the numbers, are growing, they're doing everything right, they're making huge profit margins, everything looks fantastic, yet the share price is very, very low. And for me, this would be a bargain. For me, at 25 pence per share, when people are saying to me, would you find Aston Martin a bargain? Right, for me, the answer is no, because until they actually show that they are turning things around financially, I'm not interested. Well, here's a company that are ticking all those boxes, that do look financially strong, and yet their share price is very cheap. And for me, this does look good. For me, this is an opportunity. Now, I can't guarantee the share price is going to go up. It could continue to go down to zero, and we might never hear of this company again in a couple of years' time. That's definitely a risk that you have to bear in mind here. So I wouldn't recommend chucking all your money into them. But looking at comparing Aston Martin to this company, I'm more interested in this company because the financials look strong, and yet we've got a cheap share price. And so these guys certainly have the opportunity to do well. This is a company making 20% net earnings a year. That's good. That's really, really good. That's up there with some of the best companies out there in terms of the efficiency and that, obviously in their relative size. But this is up there. And so for me, this ticks the boxes of a bargain opportunity. A risky one, of course, but still, if you're into that sort of thing, if you're into the kind of AIM shares, you're into the penny stock sort of stuff, this is one of those few companies that actually, they deserve to be higher probably. And maybe the market will fall in line with that eventually, and investors will cotton on, because right now it doesn't seem like they have. So yeah, let's go and take a look and see how they did on the leaderboard. Okay, so I did warn you this was going to be a risky company with potential. OPM are definitely that risky company. Trading at 24 pence a share, first of all, so very, very low price, as we saw in the chart. The earnings per share for this company is 6 pence a share. So when you're looking at 24 pence per share to buy the company, if you were to buy all the outstanding shares, of which there are about 90 million shares, if you were to buy them all at 24 pence per share, the earnings per share that you'd be making is about 25%. What that tells me is that that share price is incredibly low right now, relative to the intrinsic underlying value of this business. You can also price them by looking at many different ways. Another way I tend to do it is with the assets or the equity of the business. The equity per share is 64 pence a share. So this is currently trading at 24 pence a share, and I would be getting into this company if they were trading at 60 pence a share. So based on price alone, forgetting the fact that, looking at the financials, just on price alone, I would be looking to get into this company at anything from 60 pence a share or lower. They're trading at 24 pence a share, which should indicate that this is a company that are trading at a share price far lower than their intrinsic underlying value would suggest. And so we've got the kind of makings then of a very good opportunity, a bit of a bargain. Obviously, there are risks that come with this, bearing in mind what they do. And in 2020, that is the risk that you're going to be taking if you decide to invest in a company like 1PM, because share price is very low relative to the underlying value, which is great. Financials up until 2020 looked fantastic. They look fantastic, absolutely. The question is, how much of an impact has 2020 had on their business? And that is the risk you've got to take. And so you can do your due diligence, you can do your research in this company. You absolutely need to do that for a company like this. But if you like what you see and you have no other concerns of this company, getting in at 24 pence a share would be a very good price to get in at a company of this size. So that's where I'm going to leave it with you guys. Let's get them up on the board and see how they scored based on the criteria I look for, to see whether or not the odds are high, whether or not they're going to be a 300 to 400% growth company over the next 10, 20 years. So, OPM is the EPIC code. Let's get them up on the board. And yeah, I think that's a very fair score. I always say that every week, but the scoring algorithm has been designed to assign points to companies that do tick all the boxes, to take points away if there are any concerns or if they're the polar opposite of what I'm looking for, which is why some of these companies score very, very badly. But OPM, 1PM PLC, Epic code OPM, score 72 points, which I think is a very, very fair score. So let's get them up on the board first of all. Okay, so they make it onto a very good position on the leaderboard, sitting there at 8th place with the likes of Sage, Treat PLC. These are very good companies. So OPM looking like a great opportunity. Before I go, testament to just how messy my office is, I found all of these dead companies that have since dropped off. Today we lost Tesco PLC off the board. So many investors flock to these kind of companies when actually they tend to be some of the worst companies you can invest in for the long term. Companies like Tesco, we lost Tesco today, they're off the board. Companies like Centrica, we lost them ages ago. All of these companies we lost a while ago. Dixon's gone. TLW, was that Tullow Oil, gone. Rolls-Royce, gone. Scored minus 103. I got lambasted for this. I got hate mail from people when I said that I wasn't invested in Rolls-Royce and given them minus 103 points. It didn't go down well. But look, they've cut another, 10,000 jobs now. Listen, I don't want anyone to lose their jobs. I'd love Rolls-Royce to do well, but the financials and the facts don't look good for them. PZ Cousins, gone. Vodafone, gone. Aston Martin, another company that people seem to love, I guess it's the Formula One link, gone. So these are big companies. We're looking at BP being bottom of the table now. They'll be the next company to go. These are big companies that beginner investors seem to flock to because they're big names and they think to themselves, well, who do I invest in? Let's invest in the companies that I know, the brands that I understand. And the problem is these companies aren't necessarily the best companies, the best investments for your capital over the next 10, 20 years. And so, that's partially why I do this channel. to kind of talk about these companies, to open people's eyes into the raw numbers. Listen, you don't necessarily have to agree with what I think. You don't have to agree with my leaderboard, but you've seen the numbers, and that's what we show in this episode, in these episodes, in this series on this channel. Is we look at the actual numbers to enable you guys to make your own minds up. And if you don't agree with me, that's totally fine, not an issue. Don't disagree with me because you think the stock's going to go up over the next 2 weeks. Well, I've got no opinion on that. That's not the opinion that I'm trying to make here. I'm talking about these companies being good long-term investments. These companies that we just got rid of off the board do not have the odds in their favour of them being 300, 400% return businesses and share price growth businesses over the next 10, 20 years. They're just not geared up for that. Some of them may make it. Aston Martin may be the best opportunity and over the next 10, 20 years, and I may miss out on a fantastic opportunity. But right now, the numbers do not reflect that. The numbers do not suggest that, and the odds are against them of being that kind of company. And I'm not going to take that risk, and that's essentially what I do. That's me. So thank you very much for watching, guys. I hope you are enjoying this series. I hope you understand where I'm coming from, what I'm trying to achieve here. Thank you for all your support, and I'll see you guys in the next episode. Cheers.